And let's ask Adam Parker. He's the founder and CEO of Trivariate Research, also a CNBC contributor, and he is here with me at Post 9. Welcome to the new program. It's great to have you here.
Thanks for having me.
What is up with the market? We're cruising for our worst day of the year. It felt like the bulls had the upper hand for the last, several weeks. Are they giving that up now?
Well, I worry a little bit the consensus has shifted. We started off the year with the overwhelming consensus being, hey, we're going to be down in the first half of the year, up in the second half. I can't own anything that loses money, so naturally market goes higher and the things that lose money go up the most. But I think, right around now, I think the sentiment has shifted toward, well, maybe things will be better. There's going to be money flowing in. The economic data have been strong. So, yeah, maybe the Fed won't be as dovish, but the bear case in earnings isn't as likely. So the market kind of absorbed what I think 6 months ago would have been interpreted as hawkish for the Fed as okay.
This is all about the way that rates are rising, though, isn't it? The more that rates go up, and by the way, they've done so in a reasonably short period of time,
right?
That's putting the pressure on stocks, right?
I think so, and I think pause is now the new cut, meaning like you don't really want the Fed to cut rates this year because that means the economy is nosediving and corporate earnings are nosediving. What you wanted them to do was feel like, hey, things are eroding, not imploding, and they'll maybe hike less or kind of pause. But I don't think what you want is them to cut, whereas 6-9 months ago, yeah, we want a more dovish Fed. That's good for equities.
But that's what everybody was hanging their hat on.
Yeah.
I want you to listen to what Mike Wilson said on the network today on why we got here in the first place and where it leaves us. Here's Wilson.
We thought there could be a pivot on February 1st, but then, of course, the data came in a bit stronger. And the Fed doesn't want to give any chance to inflation rearing its head again. So we think there's at least 2 more hikes, maybe 3 going into June. And, that got priced into the bond market over the last 30 days, but stocks seem to have ignored it. And so what we're left with is just stocks are more expensive. And there's really no justification for that because the earnings picture really hasn't improved yet.
Right? I mean, this is the idea that you've had multiple expansion based on what? And now we're coming to the reality that, okay, well, the Fed's not going to pivot. And if anything, because the data has been stronger than we thought it was going to be, they're going to remain higher for longer.
Look, the worst thing is when you work at a big firm and you're bearish and you're wrong. Like I've been there, bullish, bearish, wrong, right. You're going to be in all 4 quadrants in your career when you work at a big firm. The worst thing is when you're bearish and wrong.
He's been more right than wrong, though.
But in the last 3 months, the market's ripped, and I'm just telling you, I've been in that seat. It's a pain. You're in the hurt locker.
I know, but you're going to change your call every 10 minutes?
You can't. So you either have to say, hey, look, I agree, the market's not as cheap as it was. I think it's pretty expensive. You've seen semiconductors go from 17 times to 25 times. There's been big rallies. It happens. I think we're going to be in a more volatile market. I think the setup for us has been, how do I outperform? And that's where, we don't really do the market stuff because people don't really pay for that. We kind of think about how do we outperform underneath it. It's either cheap cyclicals where balance sheet repair can happen in an eroding market. Interesting, on a big down day today, copper stocks are up. Energy is relatively massively outperforming. In the past, when we had a big down day, those things would have been slaughtered. So I think the cheap cyclicals are getting a bid. And I think or stuff that can kind of grow through, meaning their 2024 earnings and cash flows will be better than 2022. So I think that's still the recipe for outperforming. And what's interesting in the meetings we're doing, the growth guys are saying, I don't really have any cyclicals I can own. And they have like an envy of those guys. And the value guys, I wish I could get some growth. Everyone wants something else besides what they own.
Because most people were not positioned right.
They're not positioned
coming
right.
into
That's right.
this year.
Because they were short the profitless companies and bearish on the market.